The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, the 15th of August. Welcome back, Jeremy. Good to see you again.
Hi, Gareth. Yeah, good to be here.
Good stuff. It's been an interesting week. Why don't you kick us off by just talking through what you've seen from the macro side? I think there's been quite a bit going on in the UK.
Yeah.
Across the course of the week.
So the UK continued its resilient, if modest, growth trajectory of the last 18 months. We had GDP figures for the second quarter, and on a year-on-year basis, this came in at 0.9%. So Q2 this year versus Q2 last year. But growth in May and June were slowed, and June was pretty flat, giving a quarter-on-quarter performance in the second quarter of this year of just 0.6%. This figure put the UK in third position among G7 economies, so doing okay. And is likely to put pressure on, or allow for, at least, further interest rate cuts at the next Bank of England meeting.
So still growing, but slightly below expectations. So interest rates still hopefully on their downward path.
Yeah.
Okay.
So in terms of attention for the UK economy, I think that will now start to focus on the September budget. Mm-hmm. Rachel Reeves' first budget, and the prospects around the government's sort of promised growth plans, front and centre of which will be planning reforms and ambitions for increasing house building and infrastructure development. But of course, there are also quite a few kites already being flown from the Treasury about the need, the requirement she's facing to increase the tax take and how it's all going to be financed, and her wish to close the much debated 22 billion fiscal black hole that she claims she has inherited. So overall, following a period of better than expected, sort of above trend growth in the UK economy, I think the risks are heightened of returning inflationary pressures, albeit this week we had UK inflation data that was a bit mixed. Inflation at the retail level rose from target 2% to 2.2% in the month, but is continuing to decline at the producer output level, at the PPI level measured on an output basis.
Okay.
Albeit at the input level for PPI, the numbers are starting to go up. So this implies that producers, companies are having to absorb some increasing cost pressures. So that's maybe a slight concern, a flag for just keeping an eye on.
So inflation's down but not out.
Yeah. Correct. Yeah. And I think we're ahead of the G7 in terms of where we've got our retail inflation level too, but I don't think there's any room for complacency. One of the sort of cost pressure areas that of most attention is to do with wage costs and employment costs. This week we got employment data for June. So this is slightly backward looking, as this data often is, but this data didn't support this increased inflationary fear. So the data showed modestly declining unemployment rate, slower wage growth. But looking forward, one has to be mindful that we might be about to see some quite significant public pay settlements coming into these figures in the second half.
Yeah, they certainly seem to be signing them up quite quickly. These pay deals are coming through almost by the day now. So yeah, you'd expect those will show up in the wage inflation relatively soon. Yeah.
Yeah. But overall, the market took all this pretty well in its stride. And I would say the main indicator for this is where the pound is. And that despite the Bank of England having initiated its rate cutting cycle already, the pound broadly strengthened this week against a weakening dollar. And as we speak, the pound is trading at around 129 to the dollar. So it's back bumping up against recent highs. We've had a rate cut, and the UK economy, well, certainly our asset markets, our stock markets, seem to be in quite good fettle. The surveys of the fund managers suggest that the UK is now not just one of the increasingly popular, but probably one of the most popular markets for global fund managers to allocate to. So this really is quite a big change. And although people might say, well, hasn't really reflected significantly in UK share prices yet, I think these things do take time. And as we commented last week, the UK broadly stood on the sidelines as bigger markets, deeper equity markets were hit by much greater levels of volatility. So I think the UK is in a good place. In fact, I had a meeting with a UK-based fund manager this week who said they'd been told by an overseas family office investor that they weren't going to allocate to them this month because all their global managers with wider mandates were increasing their UK exposure and they didn't want to be too overexposed to the UK. So just anecdotal evidence, but I thought that was quite notable.
That is positive. What else has been going on more broadly? I mean, there are lots of useful and generally positive news from the UK perspective overall. How about across the rest of the world?
Well, things, I'd say overall globally continue to normalise following this huge spike in volatility surrounding the Japanese carry trade that we got early last week, which impacted Japanese equities, the yen, and US equities, largely the big tech stocks. And the equity market subsequently recovered its nerve and sort of indicating the soft landing hypothesis, albeit bond yields and bond markets, in terms of discounting more significant rate cuts, are probably more pessimistic in their outlook. So I think there's a bit of a mismatch there.
There is. I saw some bits of the press talking about the carry trade, and one or two people were suggesting that they thought, given the volatility that we'd seen, that maybe the carry trade was sort of done. You know, it had wound itself down and it was okay again. We didn't need to worry. Do you share that view, or is that a bit rose-tinted?
Hard to know. The estimates I've seen of the scale of the carry trade is measured in trillions, as we talked about last week. The range seems to be from $1 trillion to $25 trillion that is subject to this carry trade. So the answer is no one knows. And I don't think even the policymakers really know. But nothing has really changed other than the Japanese central bank has said they don't intend to raise or normalize rates any further until markets stabilize. So that's nothing other than a temporary stopgap. I mean, if it is $25 trillion, I mean, that's more than the GDP of the US. Now, if it's anything like that sort of number, it would indicate all manner of risk assets are basically being financed by cheap Japanese money. And to come back to this idea that this phenomenon is over and done with, well, you know, a hedge fund manager can still today borrow yen at 25 basis points and buy short-term US Treasury notes that are yielding over 5%. So you've got a 475 basis point pickup by doing the trade today. And the authorities have basically said, we're not going to spoil your fun in the short term.
Yeah.
But I wouldn't say it's safe to get back into the water fully just yet.
Okay. One to keep an eye on then.
Yeah.
All right.
Elsewhere in markets this week, the oil price and gold price both firmed up as tensions in the Middle East and Eastern Europe have recently escalated. We're waiting for the Iranian response still, and we've had sort of the initiation of a Ukrainian offensive into Russia. So slight oddly and counterintuitively, the dollar has, in all this, has continued to ease, and it's actually eased now for best part of 6 weeks, leading some to speculate that this is a deliberate policy of dollar weakness. Could just reflect the increased likelihood of lower US interest rates. But, you know, one would expect as geopolitical tensions rise normally for the dollar to strengthen. And I think it's interesting that that hasn't happened. As ever, there's always mixed data all the time. And today we get a double whammy of actually quite good news regarding the health of the US consumer and thereby probably the US economy. with both higher than expected US retail sales data and upgraded revenue guidance from Walmart. So the US economy is not giving up the ghost quickly, but I think all this and much more will be machinated and discussed at the Jackson Hole meeting in a week's time, where we will certainly get some smoke signals about the next leg of the rate cutting cycle as far as the Fed's concerned. And again, my concern remains that the existence of this yen carry trade could prevent the Fed from cutting rates as quickly as they otherwise would like, and the market is currently discounting. So therefore, I think that in the absence of anything else right now, this volatility that we got last week, I don't think we've actually seen the end of it yet.
No. Okay. Yeah, it feels like there's a lot more information that the markets need, or they're waiting to hear from Jackson Hole or from the performance of the big economies. So yeah, there's lots more.
Yeah. But I think the big takeaway is that the UK is probably increasingly a good a place as any, if not one of the best places to sort of sit out the storms that might be seen elsewhere.
Yeah. And you've made the point before that our political or economic risk is a lot lower than many other places, and they're going through what could be quite turbulent times. And that hasn't changed. I think, if anything, it's just playing itself through.
Yeah.
Yeah. Hopefully we'll remain as an exciting and potentially lucrative place for global capital to be allocated.
Yeah. So what about the UK this week? What about companies in the UK? What sort of caught your eye?
Yeah, so we've had a couple of progressive clients and one non-client. So that the progressive clients are Beeks and CML. They've both had a bit of news. And the other one is Accesso Technologies. So Beeks first, as a provider of cloud-based trading platforms. Yesterday, they said that they'd received regulatory approval for the implementation of their exchange cloud platform for a major global stock exchange. That deal was actually announced back in February, but the regulatory approval was obviously key to the progression of the contract, and that's now been done. So it's a big step forward for them, been well received. The stock continues to trade very nicely, and they've said that we'll hear a bit more about the detail of that once their customer, the stock exchange, is able to launch that product onto their end customers, because they'll be selling that together or working with the exchange to make it available to the exchange's customers. So it'll be good to see a bit more about that. Then CML, they had an AGM update back on Tuesday. CML Microsystems, it's a provider of microchips into the transitional radio spectrum market. So it's a niche specialized business, but they had a pretty upbeat AGM statement on Tuesday saying that trading was slightly ahead of last year and reassuring people that they feel they're on track to meet their full year expectations as things stand. So nice positive comment from CML. But then Accesso Technologies, they came out this morning with a statement saying that effectively trading across their customer base, which is they sell technology or software platforms into providers of leisure resorts and operators of those sorts of facilities. They've said that trading volumes across their customer base is lower than expected. And seeing as their revenue is at least partly based on the levels of footfall or the levels of expenditure by those consumers going into the resorts, that's been pretty bad for their current trading. The shares are down by almost a third today. So that hasn't been well received.
Yeah. Well, I think they call it revenge travel spending since lockdown has really boosted stocks like Ryanair, EasyJet, Jet2, Accesso. I think it's a very interesting software services vertical provider, and has done pretty well out of sort of capturing revenues on that sort of travel recovery story. But yeah, I think this is an interesting indicator that market theme may have just played itself out in the current period.
Yeah. Okay. Let's leave that in terms of the UK. What about next week?
So the only things I could see on the horizon for next week, really, we're going to get the minutes for the Federal Open Markets Committee on Wednesday, which could give a few headlines on the prospects for US rate cutting. We get Japan's July inflation data, which is probably going to show an increase in inflation from 2.8% towards 3%.
Okay, get a little bit more information about that next week. It'll be interesting to see. So great. Thanks very much. Good to catch up, and we'll speak again this time next week.
Okay, see you then.
Brought to you by Progressive Equity.